You know, for many, many years, you've been saying that the stock market over time goes up, and it's a great economy, great country, great things happen. I don't know if you were thinking about the coronavirus. How has that changed your long-term view of the stock market?
Well, it hasn't changed the long-term view. Certainly a short-term shock of unprecedented magnitude. I mean, the numbers were tragic, but not surprising from what we see. And really, I follow economic news all the time, but I've been following less these announcements that we've been getting because it's the rear view mirror. You know, when I get up in the morning, actually, I check all the virus data, the trends in the virus, the trends in the developments in therapeutics, in vaccines. I mean, like the interview that you just had with Stefan Bancel or Scott Gottlieb, who's my guru. That, to me, more informs what is going to happen in the future than getting some historical report on how tragic this virus has affected our economy.
So what's long term and what's intermediate term, and when do you get back to doing what you would normally do? I mean, are you going to take off a year?
Well, one thing that's very important and something I emphasized very early on when we began to get this virus news, and I think it's an important reason why the stock market has actually held up so well, is that more than 90% of the value of stocks is from earnings more than 12 months in the future. So these next 12 months are going to be disaster. It is a disaster. But stocks are the longest lived assets, and more than 90% of their value is earnings from the second quarter of 2021 beyond. Now, what we're going to be there depends on therapeutics and vaccines. And that's why any encouraging news on that is so great for the stock market, far more important than, whether unemployment claims are going up or down, or durable goods are going up or down. I mean, we know that this impact has been dramatic. If we get therapeutics that reduce the severity of this disease to a bad flu, or a vaccine that could inoculate the at-risk members of the community, again, that reduce that fear, I think 2021 can be a boom year. So with the liquidity that the Fed is adding, unprecedented. It could be a really good year.
So, okay, two questions. Number one, you think when we were at the lows, whether a month, 6 weeks ago, whenever that was, you think that was a time that if you could have stomached it, you should have actually been buying? And do you foresee any problem with the government and the Fed extricating itself from this, which could maybe put a damper on what happens 12 to 18 months out?
I do think that the March low is definitely going to be the low. I mean, the only worst case scenario is if there's a huge second wave in October, we don't have therapeutics, no vaccine is available, and the second wave of the Spanish flu, as you know, was actually more severe than the first, and there's a total shutdown again. I mean, that's the only scenario. Now, I don't think that's going to happen. I think that's a low probability event. It can't be taken off. What the statistic that I actually look at very closely, and this is related to your question, is the monetary expansion. The monetary expansion, M1 money supply, has gone up 19% in 6 weeks. That is unprecedented. That is more than the entire year that followed the Lehman bankruptcy in September of 2008. So in 8 weeks, we have expanded liquidity in our financial system by more than we did in an entire year before. That liquidity, once confidence begins to recover, wow, I mean, that's going to go into spending, and I think that's going into the stock market. And I think one reason the stock market is only 15% below its all-time high is they're looking at that liquidity and say, hey, where is that going?
So you think the lows are in. You think that it's possible that we see new highs within the next year and a half, 2 years?
Yeah. I actually do think it's possible with that liquidity going into the market. I also think there'll probably be more inflation than we've seen in 2 decades. I'm predicting 3-4% inflation. I know that seems impossible now because prices are going down so much. But again, when this liquidity's got to find its somewhere to go, it's all being repressed. It reminds me a little bit like World War II. You know, everyone is rationed. The Fed built up a lot of liquidity, and it exploded in the post-war boom that we had that no one expected. You know, the world was thinking, oh, we're going back into depression. Military expenditure is going to be way down. And instead, that liquidity built up, had a consumer boom, and was very good for the stock market.
Why wouldn't Jeremy? Why wouldn't a $10 billion, why wouldn't a $10 trillion balance sheet and 25 trillion or whatever it's going to be in fiscal, it'll be even more than that by then. Why wouldn't that, when it's engendering inflation, cause rates to go up to where we'd really have a problem? And a lot of times when you have interest payments that high, it puts a damper on economic growth. Well,
rates are definitely going to go. I mean, I think the 40-year bull market in bonds, which is one of the longest bull markets in world history, is over. We saw the lows in March, and we'll never see those lows again. And I think rates are going to go. The Fed will keep the short rate low for a long time, and they're going to let inflation run beyond its 2% limit. The long rate's going to creep up 1, 2, 3, 4 as we get to 21, 22 going forward. We're not going back to those, 16% rates we had in 1981, anything like that. I'm not predicting hyperinflation or anything like that. I'm just predicting a much more stronger push on this liquidity into these next few years. And, moderate inflation is not bad for the stock market. It is terrible for the bond market, but not bad for the stock market.